Hello fellow compounders, welcome back. If you're a beginner in the investing world and you've heard of the target date funds and the 3-fund portfolio but aren't sure what they are or how they differ, you're in the right place. Today we're going to review two popular approaches beginner investors can use to simplify their investment program. We will compare both approaches and give an example on how to implement both programs. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor and you're responsible for your own financial decisions. Let's get started. What is a target date fund, or TDF for short? Imagine you're planning a journey and want your travel mode to change as the terrain changes. That's kind of how a TDF works for your retirement savings journey. A target date fund is an all-in-one investment fund that adjusts its holdings, like the proportion of stocks and bonds it holds, based on your expected retirement year. For example, if you plan to retire around 2055, you choose a 2055 fund. Early on, that fund will have more stocks. These stocks are essentially shares in publicly traded businesses representing ownership. And as you get closer to 2055, the fund will lean more into bonds, which are like loans you give out in exchange for a periodic interest. This is what we call fixed income. Let's use Vanguard funds as an example. If you picked the Vanguard Retirement 2055 fund, ticker BFFVX, you're getting a mix of stocks and bonds that will adjust automatically over time. You don't have to worry about rebalancing the portfolio. The fund does it all for you. All you have to do is decide when you'd like to retire and invest regularly into the fund. It's that simple. Now let's move to the Boglehead's 3-fund portfolio. Think of this as a simple recipe using only 3 ingredients to whip up a diversified investment dish. I did a detailed video on the 3-fund portfolio, and here's the link. 3 ingredients? Yes, a domestic stock index fund representing the US stock market, an international stock index fund for global exposure, and a bond index fund for stability. For Vanguard fans out there, here's how you can build the 3-fund portfolio using their ETFs. 1. For domestic stock, we'll use Vanguard's Total Stock Market ETF, ticker VTI. Number 2. For the international stock portion, we'll use Vanguard's Total International Stock ETF, ticker VXUS. Number 3. The bond allocation. We'll use Vanguard's Total Bond Market ETF, ticker VNB. Okay, so we've covered the basics, but how are they similar and what sets them apart? Both the target date fund and the 3-fund portfolio aim to simplify investing. They're diversified, meaning that they spread investments to reduce risk, and they're great for long-term, hands-off investors. The difference lies in control and flexibility. With a target date fund, everything's automatic, whereas with the 3-fund portfolio, you'll occasionally adjust and balance and rebalance between those 3 ingredients that we talked about. Every investment strategy has its pros and cons. With TDFs, you get the convenience but might pay slightly higher fees. With the 3-fund approach, you have more control but need to be a bit more hands-on. Imagine 2 friends, Amy and John. Amy, who's super busy, might prefer a TDF like Vanguard's Target Retirement 2055. She sets it and forgets it, and it auto-adjusts. John, on the other hand, is a do-it-yourself enthusiast. He goes for the 3-fund portfolio using Vanguard's ETFs that we mentioned. He enjoys checking in occasionally and making tweaks. Both TDFs and the 3-fund portfolio offer simple paths to grow your money over time. Your choice depends on how hands-on you want to be and what fees you're comfortable with. Remember, investing is a journey. Whether you use a self-driving car like the TDF or occasionally adjusting and steering like the 3-fund portfolio, the goal is to keep moving forward. All right, now that we've got the basics down, you probably are wondering, how do I get started with these? Don't worry, I'll break down the steps for both. Starting with the target date fund. Number 1, determine your retirement year. First, estimate the year you plan to retire. Let's say if you're 28 now and plan to retire at 60, you're probably looking at retiring in 2060, the year 2060. So number 2, select a fund. Based on your estimated retirement year, pick a target date fund. Using our Vanguard example, or following on our Vanguard example, you choose the Vanguard Target Retirement Fund 2055. Number 3, invest. Open an account with the fund provider. In this case, it's Vanguard. You can usually do this online. And once you've set up the account, decide how much you want to invest initially and set up recurring contributions if you want to automate your investments. 4, monitor your investments. Remember, TDFs are designed to be a set it and forget it approach, but it's still a good practice to check in yearly. Ensure that you're comfortable with its performance and that your retirement goals haven't changed. Now, for the boglehead's 3 fund portfolio. Number 1, determine your asset allocation. Decide how you want to split your investments between domestic stocks, international stocks, and bonds. For a 28-year-old, a common split might be 60% domestic stocks, 30% international stocks, and 10% bonds. This will vary based on your risk tolerance and investment horizon. Number 2, open a brokerage account. Any stockbroker will let you trade ETFs. Platforms like Vanguard, Fidelity, Schwab, M1 Finance, or Robinhood should work just fine. If you've chosen to invest in Vanguard's ETFs like VTI, VXUS, and VND, you might consider using Vanguard's platform, but you don't have to. You can easily buy Vanguard's ETFs using Schwab, Fidelity, or any stockbroker. Remember, ETFs trades on the stock exchange just like stocks. Number 3, purchase the ETFs. Once your account is set up and funded, buy your selective ETFs in the allocation you've decided. Number 4, regularly rebalance. Unlike TDFs, the 3 fund portfolio doesn't auto-rebalance. At least once a year, check your allocations. If they've drifted from your original plan or your original allocation due to market changes, sell and buy as needed to get back to your desired allocation. Set a reminder to do this, whether it's an annual alert on your phone or a note in your planner. And there you have it. Whether you're leaning towards the autopilot nature of the target date funds or a slightly more hands-on approach in the 3 fund portfolio, taking the first step is what's crucial. Remember, the best time to plant a tree was 20 years ago. The second best time is today. Thanks for watching. Remember to always be compounding. See you in the next video. Take care.